Okay, we are live. This is Invest in You with Fredrik Sandvall, and all the way from the UK. I got John Andrews, and we mentioned in the pre-call, like, how did this actually happen? And I've been following John's work for easily 9, 10 years, and I love what he's doing, helping the community of making deals possible. And let's dive in. Hi, how are you doing today?
Yeah, very good, Frederick. Nice to meet you, and thanks for asking me onto the podcast.
Yeah, absolutely. Absolutely. So there are lots of founders on this call. So there will be people like, so we see this from the buyer point of view and the seller, because we have very much both. And we are in a super global audience, so well over 150 countries. So far and wide, and for people who are not in mergers and acquisitions, feel free to stay with us because you will for sure pick up ideas how you can grow your business as well. So with that said, most companies are not sellable. Why?
Um,
Sorry to put you on the
uh,
spot.
um, no, not at all. So most companies aren't sellable because, first of all, the founders don't believe they're sellable,
Yes.
and there's always a market for a business if it's structured well, if the owners are running it well, and
Yes.
if they've got the processes and procedures in place. Um, and in the UK, for example, there are many retail businesses. I've got a client, for example, who is very acquisitive in the area of buying hardware stores.
Yes.
Which, if you'd have asked me a year ago, is that a market where people want to buy? I'd have said probably not. But they've got a particular interest in that area. They've built a specialism up in that area.
Yeah.
So that just proves to me that if you get your business structured right, that there will be a buyer for it. So you need the belief, first of all. And then
Yes.
secondly, you need the processes in place.
Absolutely. I mean, there are so many like words flying around in the space. You might find a podcast or YouTube, and right now there's too many people talking about this that have never done a deal. So there's like, what is due diligence? Will you do it yourself? Will you negotiate yourself? Deal structuring, there's so many ways to do it. And then ultimately, what does even an exit mean? So with all of that in mind, let's jump into a question for you here, John. So when people hear mergers and acquisitions, they might think like the multi-billion deal. And right now, especially on social media, everyone is talking about billions, billions, billions. But ultimately, a billion is a huge number. So more realistically, into the hundreds of thousands, or even like the millions. What size of business change hands more than anything? Like what kind of size?
Well, I think we operate almost exclusively in this office in the SME market.
Yes.
So typically, those deals will be anywhere between 250
Yeah.
and probably 20 million.
Yes.
You might push that figure up to 50 million, but the average deal that we're dealing with here is going to be between £2 and £5 million. Um, and that's a very buoyant market,
Yeah.
irrespective actually of external economic factors.
Yeah. Yeah. You probably at least have got minimum three, four of your clients on this podcast already without you knowing.
Right, right. That's good to hear.
Yeah.
And the reason I say that there's a market that's always active is that
Yeah.
I think that when the economy is good, owner managers want to cash in
Yes.
and get the best price for their business. When the economy is bad, very often owner managers, if they've been through a number of cycles, decide they want to
Yes.
exit. And there tend to be people around who have got cash. They may have been employees for years and they've exited those businesses for a number of reasons, whether it's
Yeah.
redundancy, retirement, and they're looking to do something new. So there is always a market for SME businesses.
Yeah. Good point. So at the moment in the space where you're operating the most, who are the typical buyers and why are they buyers today?
I think typical buyers at the moment are people who have been inspired by podcasts, much as your own.
Yep.
There's so much information out there now about buying businesses, and
Yes.
what people are realizing is that rather than start from scratch, where you need the infrastructure of maybe an office, a
Yes.
website, a database, the better process to follow is to find a business that you can acquire, and if
Yes.
you can structure that deal in the correct manner, it doesn't mean to say that you have to have a pot of cash to fund that acquisition. And I
Yeah.
think what's happening is there's lots of people that are being inspired by people like yourself, like Jonathan Jay, and
Yes.
thinking, well, do you know what? I've been an employee for years. I want to do it myself. And there is a route to do it that doesn't involve
Yeah.
completely starting from ground zero.
Exactly, really good. So we'll park the conversation about like you should really search for advice if you're on the buying side. I like to focus for a second on the potential seller. So I recently just published a book where you basically, I call it option strategy. You got like three doors as the owner operator. You are also you might or might not be the founder. So like door one, like keep grinding the way you always have, like no help. Number two, work
Yeah,
with some kind of like specialist. It might be an M&A person, might be a coach, it might be a mentor, it might be engaging with a team to plan for the future, like door number two.
yeah,
Or number three, I know I am doing it, and also many people like me are doing it, where you partner with the exiting owner to work together for a few years to grow it together.
yeah.
So I guess you've seen probably all of those things, but my main point with the whole book is always try to be sellable by having your affairs in order. So parking my strategies and what I do, why is it so useful to always be like prepared to sell today, even if you never will? Why is that
Well,
most
I think the key to it is this: is that if you run your business on the basis that one day you may want to exit,
yes.
you know that you've got the processes in place and
Yeah.
you're running a tight ship. Um, Very often, what happens is that owner managers have a lifestyle business,
Yes,
so
indeed.
um, good cash flow, but they will use that to fund their holidays, their home
I've done
extensions.
that.
Maybe put a nice car through that. Now,
Yeah, I've
there's
done
there's
that
nothing
too.
wrong. Exactly right. There's absolutely nothing wrong with that,
Yeah,
provided it's within the legal parameters.
indeed.
However, if you then suddenly decide one day that you want to sell your business, you're going to go to a buyer or potential buyer and say, my business is worth 3 million quid, and they'll say,
Yeah,
well, that's not what the last 3 years accounts are
exactly.
telling me,
Yeah,
and you won't get the offer you want. So, by all means, take advantage of the fruits of your hard work. But the reality is, if you are wanting to build real value and sell your business, you need to be thinking it's a 2 or 3 year process
yeah,
to really get the price that you want. If you're operating it as a lifestyle business, if you're not doing that, and if you are operating it as a really tight ship and your accounts are truly reflecting
yeah.
what your profit is, you can sell at any stage. You won't have that 3 year wait in trying to get your books in order. And,
Yes.
and the starting point in any deal is going to be, how much can I sell? How much can I sell for? Uh, and for any buyer is, well, how much am I willing to pay?
Yeah,
And the starting point for all of that are the accounts. As I always say to clients that come to me, whether I'm acting for a buyer or seller, if the figures don't stack up, there's no point in wasting money on lawyers,
yeah.
because you won't get past space one.
Yes.
So the starting point is, make sure you're operating a tight ship financially, and if you're operating a lifestyle business, bear in mind, if you want to get the best price, you're on a 2 to 3 year process before you're exiting at the
Yeah.
price you really want for it.
Good point. So just for the audience sake, I was operating a business. We had assets worth 6, 7 million plus, and we did exactly what John is saying here. We stripped out all our personal expenses and made it clean. And what triggered that was actually the number of inquiries, unsolicited inquiries, because this was in real estate. So of course, people can find out details on company's house and through the land registry, and people are just reaching out like to buy the portfolio or the whole company, and to then move to take away all your stuff, maybe put in a different company where you put your personal expenses and training, education, and everything else. It now gets so much easier when, if you ever actually exit that business. And I actually did in due time. So I
Yeah,
did exit that business. Yeah.
yeah, I think that's absolutely right. And And where you end up then is, and the way you structure that, by the way, is a fabulous way to do it.
Yeah.
And if you have a group structure that
Yes.
enables you to strip out expenses,
Yes.
put different assets into different protective entities,
Yeah.
then that's certainly the way to go.
Yeah, let's dive a little bit deep because I've heard your really masterclass on various podcasts about exactly this. So for the people who think about setting up their own little like company group, what are some of the fundamentals?
Yeah.
Explain the acronym SPV, holding company, and why it's useful to have like a buffer company when you acquire things. So please elaborate on that.
Yeah, certainly. So an SPV company is a special purpose vehicle company. So what that means is you are incorporated a limited company specifically to buy a particular business or asset. So traditionally in the UK, how we would structure deals, particularly if you're doing multiple acquisitions, is at the very top you will have a holding company. So that holding company will usually be owned by individuals. So
Yeah.
you'll have one shareholder, two shareholder who holds the shares in that holding company in their personal names.
Yeah.
So ultimately, when they exit, there's a route for them to take their money out. Um, what then happens is you have this holding company at the top, and then each time you do an acquisition, you incorporate a new SPV, special purpose vehicle company, which is a wholly owned subsidiary of that group company, of that holding company. So your first acquisition, you have the holding company at the top that you own in your personal name. That holding company then owns an SPV, which does the deal acquisition.
Yeah.
Now, there are a number of factors to bear in mind. So if you are going to do a share purchase, so you're going to acquire an existing business,
Yeah.
which is already incorporated, you can either use your group company to acquire the shares in that existing company directly, or you can set up a clean SPV,
Yeah.
which is wholly owned by the group, by the holding company, and that clean SPV that acquires then the target company.
Yeah.
So you've got a three-stage process. You have the target company at the bottom, you have a clean SPV above that owns that target company, and then that clean SPV in turn is owned by the holding company itself.
Yeah.
Now, why would you put that intervening SPV company in? One very good reason for doing that is that when you do a share purchase of an existing trading business, you take that business on with all the skeletons and issues that company may have historically. And one way to avoid that is to do an asset purchase, but most sellers who own limited companies don't want to do an asset purchase because for tax reasons it's really inefficient. So a seller would always invariably of a limited company want to sell the shares. So the starting point is, well, we're going to have to buy the shares. How do we protect ourselves in case there's anything nasty in the background? Well, the first way you protect yourself is by instructing a good M&A lawyer who drafts a tight share purchase agreement for you. The second thing you do is you conduct a thorough due diligence exercise. So you go through all the books, you go through all the contracts, and as far as possible, you get as much information as you can up front about the business.
Yeah.
However, none of those processes can be 100% guarantees that there isn't something nasty lurking in the background. Yes. So it might be that after acquisition, the Inland Revenue come along and do a big investigation.
Yes.
And they find out about all the personal expenses that the previous directors were putting through the business, or PAYE wasn't accounted for properly, VAT, all those sorts of issues. Tax primarily is the biggest risk when you're acquiring an existing company. So what you can do is to protect against those historical items, historical issues. Once you've done the acquisition of the target company, you could hive up all the assets of that existing trading company into your clean SPV. So you leave behind what was the original target company as a shell. What you've then done is that you leave that target company empty, has
Yes.
no assets, but it also that is the entity that, if there are historical issues, gets sued. So your clean SPV
Yeah.
is out of the picture, and it leaves you in a really clean position. So it gives you the same sort of protection as you would have if you'd done an asset purchase.
Great point.
Now,
Yeah.
just to make it clear, an asset purchase is where you have a seller. Now, either if the seller is an individual or they are a partnership, then the only option is to do an asset purchase, because there isn't any limited company to acquire. So if you're buying from a sole trader or a partnership, it will always be an asset purchase. So what you do in those circumstances is that you set up your holding company set up, you set up your SPV
Yes.
below the holding company, and the SPV acquires the assets from the individual or from the partnership. Okay.
Yeah, absolutely.
If your target is a limited company, but you're looking at this limited company, and from your due diligence exercise or from your own knowledge of that target company, there are too many hazards and skeletons in the cupboard to acquire that company, you then negotiate with the seller. You might up the price a little bit for the fact that they're going to pay more tax.
Yes.
And then what you do is you get your SPV to buy all the assets of that target company, but you don't buy the target company itself. And what that means is you leave all the historic issues of that target company with the seller and with their shell company.
Yeah. Yeah, so what we've spoken about before, different ways how you can source these potential companies to buy. Having said that, what's your gut feeling right now? As we're recording this, the world is on fire, stock market's all-time high, very shaky, everything is shaky. Is it a
Yeah.
buyer's seller's market in the UK as your like gut feel at the moment?
I would say at the moment it's a
It
buyer's
depends,
market.
it depends, it's not acceptable answer.
Yeah. So I would say, generally speaking, it's a buyer's market.
Yeah, I agree.
And the reason why I say that is we're going through one of these cycles at the moment where the world looks a pretty gloomy place to be,
Yeah,
and across the world, universally.
yeah,
And there are lots of owner managers who are thinking to themselves, maybe it's the late 50s, early 60s. What does the next 20 years hold for me?
yeah,
And at the moment, it's not looking great. So they may be thinking, I've been working for the last 20, 30 years. I want an exit. And what's the beauty of the SME market is there are people, in their 20s, 30s, 40s who are gaining knowledge about how to structure deals,
yeah,
which means they can come along to an owner manager who ordinarily may think to themselves, how do I exit this business?
yeah,
And they're offered a route out. The issue that we have here in the UK, and I think it's a global issue, is the younger generation coming through, Gen Z, whatever you want to call them, their career paths and what they want to do are very different from what the current generation are doing.
yeah,
They want to be influencers, they want to be YouTubers, or they want to get involved in the world of AI. So life is changing, but there are still people still need shops, they still need manufacturers.
yeah,
But the way that those businesses traditionally were passed on was from generation to generation. That's changing, and what's happening now is that you have a whole raft of people who are thinking, right, I want to acquire an SME business, but I don't have pots of money.
yeah,
I don't have access to easy funding because funding is expensive at the moment, and funders are far more cautious
yes,
given the current world climate. So what's happening now is there's a recognition on the part of sellers that if they want to sell their businesses, they're going to have to structure these deals either so they retain some skin in the game,
yep,
or so that these deals are structured so that essentially what they're doing is they're getting some money up front, but what they're really
yeah,
getting is an income or a pension for the next 3 to 5 years from their business.
yeah,
And once a seller gets their head around that fact, particularly as an SME business, and provided they understand that there are ways to protect their position should those
yes,
deals go wrong, um, that's where the market is going. And, it's buoyant. That market is buoyant at the moment. And the one thing that stands in the way of these deals is where you get solicitors acting or lawyers acting for the sellers who still have the old school lawyer mindset of you can't accept that risk. Now, yes, there's always going to be a risk in it, but those lawyers have to be more commercial and recognise if they don't structure deals on this basis, there isn't a market for those businesses.
Yeah. Yeah, and again, you might have someone like yourself on your side. Often what is happening, we did the exact same with real estate deals as well, to find a lawyer on the other side who is actually slightly more commercially savvy. So why is it important that, assuming that you will be working one of the listeners, and then they find a target company, and as ironic as it might seem, like you might actually have a lawyer from another company representing completely not linked to you, representing the potential seller. Why does that make sense in terms of speed and accuracy and actually getting a deal done?
Well, I think the important thing is this: when you've got a lawyer on the other side that understands the principle of these deals,
Yeah.
and when I say the principle of the deals, it's also understanding the commercial reality that's underlying them, because these deals don't work and won't take place unless the seller accepts that there is always going to be some risk in it.
Yeah.
But hopefully the benefits of the deal outweigh that risk. Now, if you've got a lawyer working on the other side who's familiar with these deals and how they're structured, first of all, you don't get into protracted arguments about whether personal guarantees, for example, are going to be provided by by the purchaser, which generally speaking, 90%, 95% of purchasers aren't going to provide personal guarantees. Secondly, lawyers who are familiar with these types of deals will know how they can best secure their client's position. So there's lots of ways to secure the deferred element. So it might be that there's a charge or a debenture over the business and assets of the company that's being acquired. It might be that the seller takes a charge over the shares that are being acquired, and if there's a default, they can actually get back some or all of the shares that have been sold. So there are alternatives to personal guarantees which don't put the buyer off of doing the deal, and give the seller as much comfort as they can have and as much security as they can have in the circumstances of the deal that they're doing. So when lawyers on both sides recognise the parameters and recognise the ways to protect their respective clients' interests, the deals just go through. And generally speaking, the documentation in these deals is going to be familiar to most lawyers that actually M&A market. Within parameters, we all use the same precedents. We know what is and isn't acceptable in terms of warranties and indemnity protection. So in lots of ways, these deals shouldn't be complicated. And my experience is that when they do become complicated, it's because you haven't got a lawyer who's familiar with acting in this particular market.
Yeah, exactly. I mean, it's very likely, and it's a bit counterproductive that you, as the potential seller of a business, your accountant is maybe looking at losing his biggest account. So he might advise you, like, bad idea, stop doing this, don't stop my revenue. The same with the family lawyer, same thing there. They might not at all be the right person to advise on this because they've never done it. Just like most sellers have never sold anything before. So that's why many of these advisors actually pay for themselves in this process.
Well, exactly right. And the other thing to bear in mind is that with lots of these SME deals, particularly in recent times in the UK, given how high our tax rates are here at the moment, what you're finding is lots of SME business, owner-managed businesses, are actually just holding cash within the limited company structure. And if they take that cash out as income or dividend, they're basically going to lose 40, 50% of that money straight away.
Entrepreneurially, much better.
Exactly right. Whereas if I come along, let's say, Fredrik, you've got a manufacturing business that's you want £1 million for, and you've got £500,000 of cash in the company,
Yeah.
I'll come along to you and I'll say, right, what I'll do is, Frederick, I'll buy your business for 1.5 million
Yeah.
with that 500,000 cash left in.
Indeed.
What
Yeah.
then happens is I complete the deal. And what I say to you is this: I'll give you 500 up front and then I'll pay the million over 3 years
Yeah.
from the cash flow of the business. What then happens is I acquire your business for 1.5 million. On the day that we complete, I use your £500 cash that's in the business to pay that to you.
Yeah.
So you get that rate of 10% or 20%, actually, has just gone up to recently,
Yeah.
rather than 50%. So straight away,
Yeah.
you're that much better off. Got that cash
Exactly.
out, and then you've got an income for the next 3 years, and
Yeah.
that income is secured by way of a charge over the shares or a charge over the business assets of the
Yeah.
target. It's the concept of it is a good one, and it's
Yeah.
making sure that the buyers understand that, the sellers understand that it's a good one, and that their lawyers understand how those deals are structured.
Exactly. I mean, there's so much good education out there, and there's even more worse education. If you like to have any direct introduction to the top ones in the US, UK, or Australia, DM me, because don't just go out shopping for who's screaming the loudest on the internet.
No, it's exactly right. The,
Yeah.
the, the, the one good thing is, though, is there is so much access
Yeah.
to knowledge and information about this. And
Exactly.
from my perspective, the more that people research this and understand it, the better the market will become.
Yes.
No doubt
Exactly.
about it.
Yeah, and I mean the more you know, the more you understand that you don't know. I mean, I've been working. We're probably very similar age in terms of what we've done in business, and
Yeah,
also a number of gray hairs. So yeah, so how might it be easy for you, the more mature you are, to connect with a potential seller? Why does that potentially make it easy for you, for the
I
older
think.
audience?
Well, I feel for the older audience, I put it this way: I think
Yeah.
that you and I are of an age where we've made our mistakes. So
Yeah.
over the years,
Yes.
I've seen deals that have gone well, and the vast majority have gone well.
Yeah.
But I've also seen deals where they've not where they've gone badly wrong.
Yes.
They're the rarity, and you learn from that experience. So what I was and the interesting thing is this: is that uh, I think the more life experience that you have, not just in terms of commercially,
Yeah.
but also just generally dealing with people.
Yeah.
So if you're going to take over a limited company, and you want to buy and build strategy, which means you can do a number of acquisitions,
Yeah.
um, you don't want to be an employee of those businesses. You want those businesses to be running themselves. What that then means is coming in and managing the existing staff. And experience gives you the
Yeah.
ability to manage those staff.
Yeah.
And there's a fine line to be walked between making the changes that you want to make and make for the better,
Yes.
and also going and making so many changes that you really upset the staff and you lose the people that you really need to run those businesses for you. And that can only come, I think, with some life experience and appreciating you can't just go in on day one
Yeah.
like a bull in a china shop and say, this is what's happening.
Mm.
These things are changing. It's a process.
Yeah. No, well put. So let's put the spotlight on why sometimes you might exit, or you might find a company which is about to have a transition. One is called divorce, another one is death, and then there are like health and sickness that might affect things. Beyond that, just like they want to change, they might have to change quite rapidly. What is the impact that you have to leave your company quickly, or you need to be quick as a buyer to think on your feet and to make a transition that works? Just elaborate on those tougher, faster transitions.
Yeah. So are you really talking about a situation where the seller has to sell,
Yeah,
or
exactly. Quite quick. Or the opposite, where the
yeah?
buyer has to be quick and flexible in terms of the deal structure, because it might be complicated with a probate, or the wife or husband departing or whatever.
Well, I think in those circumstances, I think that if we're looking at a kind of distress acquisition, essentially.
Yeah.
What you need to be careful of is that you don't just do the deal at all costs. And clients will always say to me, "How soon can you get this deal done?"
Yeah.
Well, I can do a deal in a week if you want it done,
Yeah.
but
But
the
at what
risks of
price?
doing that,
Exactly.
but at a price. Don't come
Yeah.
don't come back to me in a month's time to say
Yeah.
you didn't spot this, you didn't spot that, because a comfortable time frame for doing a deal is probably 2 to 3 months. That's the average length that a deal should take. That allows you to negotiate sensibly on the share purchase agreement or the asset purchase agreement, and to do a proper due diligence exercise.
Yeah.
But in a scenario where there is when there's essentially a kind of forced sale, generally what happens in those circumstances is you're going to get very little information from the seller by way of accurate due diligence.
Yeah.
So the way that you structure those deals is either to ensure there is a big element of deferred consideration. So in fact, if things go wrong, you haven't paid your cash out. You've still got the majority of it in your back pocket, or you have a retention. So you hold back. If you're going to pay a chunk up front, you hold some back for a period of time to protect yourself against any skeletons coming out of the cupboard. And you draft the documentation, so the share purchase agreement or asset purchase agreement, as tightly as you can, and get as much protection as you can by way of warranties and indemnities. And it's important to appreciate the difference between warranty protection and indemnity protection.
Yes.
And I'll just talk a little bit about that. It sounds a little bit lawyeristic.
No, but it's good.
But
And also
it's important
mention
to understand.
the insurance you can also work with as well. Please expand on that. Yeah.
So if things go wrong, so you buy the business and it's not what you thought it was, or there are some issues in it, the first place that you will look to is your share purchase agreement. And you have, and that will have warranties and indemnities in. Now, warranties are promises that the seller gives you about the business. So the most simple one, for example, is there's no litigation against the company.
Yeah.
Okay. Now, if you buy the business and then it turns out that there is a claim that the seller knew about, then potentially you have a claim under for breach of that warranty.
Yeah.
Now, the problem with pursuing warranty claims is, first of all, you have to show that your claim falls within the warranty scope. Okay. Yeah. Secondly, you have to show that there is a loss suffered as a consequence of that breach of warranty. Yeah. So, if the company's being sued for £100,000, then yes, there will be a loss. But thirdly, and this is the thing that most people don't appreciate, is thirdly, you have to show that that financial loss has impacted the overall value of the shares that you bought. And £100,000 claim may not, in the overall scheme of things, reduce what an arm's length buyer would have paid for the shares. Yeah. So it's that last step that can cause difficulties. And going through those three hurdles is expensive, really expensive. So unless the claim's admitted, you have to litigate those. Indemnities are different. So indemnities are where, during your due diligence process, you have identified a specific issue. So, for example, if during your due diligence you've spotted that there is a legal claim, and you then go to the buyer and say, "Well, look, to the seller, sorry, there's a legal claim there. What's the potential value of that claim?" And then what you do is you put an indemnity into the agreement that says, if that claim materializes and there is a financial loss, then you will pay back to me on a pound for pound basis what that claim is. So you don't go through the having to show it's reduced the value of the shares. It's just a pound for pound indemnity. And that's the crucial difference. So indemnity claims are far easier to prove. They're less litigious, and they have more value in the scheme of things. Their value is certain. So it's really important to understand the distinction between the two. But generally speaking, if you're having to make a warranty claim as opposed to an indemnity claim, my stock advice to clients is, unless it's a real banker and it's worth a lot of money, you won't be pursuing those claims. Exactly. So the real value of a warranty, of asking for warranties, is to flush out in due diligence any
Well,
issues,
yeah.
because the sellers think they're going to be sued if they don't disclose
Yeah,
matters.
exactly. Yeah. So again, very often this litigation comes into the hundred or hundreds of thousands very quickly, which means
Yeah,
like the share purchase agreement, if it's tight enough, or you can negotiate without doing full litigation, that is a huge cost saving, and often like you already said there, John, to just let
yeah.
go and focus on making money instead of fighting for lost money.
Yeah, exactly right.
Yeah.
So I think that a well drafted share purchase agreement will
Yeah.
strike a balance between the seller and buyer, but it's there as a tool during the negotiation progress before you've exchanged and completed,
Yeah.
to draw out as much information as you can about the business itself.
Yeah. Yeah. Which leads into another, like, for people thinking about buying and people think about selling, how much? So the price on one side, and usually I mean, one of the deals I was reviewing the other year, the accountant came up with a fantastic idea how much it would be worth. And I tried to explain to the person, like, yes, this is also not only signing for the assets of like 2 million, but you also have
Yeah,
debt worth 2 million. So you can't like
yeah,
disregard the minus 2 million, which means like, fine, I can basically take over the business and you will have like 300K and carry on with your life, like now,
yeah,
out of the business, and more importantly, get out of this and focus on your health, which was really, really deteriorated. Uh,
yeah,
and instead, it became like a no deal because this person only looked on the assets and completely misunderstood, or the accountant as well misunderstood, that there are liabilities to consider, which are detrimental with this, like, yeah, all the, in this case, it was like hospitality. So all the
yeah,
funds, which arguably is the director's loan, was actually maintenance not done over the last 25 years. So it's
yeah.
just like
Which
you
is
should,
actually,
yeah. Go ahead, please
yeah,
comment.
but in fact, I think you've almost answered your own question there.
Yeah,
So, in terms of valuation, what it's worth, the reality of it is that, um, in the SME market, a business is worth what somebody will pay for it or what somebody will sell it for. There's,
yes,
but coming back to the point you made, again, it's a really good point about choosing an M&A lawyer and not just
yeah,
going to the family lawyer.
yeah,
When you're selling your business, don't go to your bookkeeper or the accountant you've used for years. To get a realistic and honest view of what a business is worth, you need to go to an accountant that deals with the sale and valuation of businesses.
yeah,
The problem is, you're quite right. If you go to the traditional family accountant you've always used,
yeah,
um, they're not going to give you best advice. So they may give you an unrealistic
yeah,
expectation of what that business is worth. They might undervalue it, but for the sake of going to somebody who deals in the M&A market and is an accountant that's familiar with the process, it's worth the extra bucks.
yeah, exactly. Yeah, actually, one of my co-hosts, one of my sons, Ivan, he's not on the call today. I said, like, you have to be on this call. It will be really great. Like, he's actually doing negotiation training right now as we speak, at university. So it's really funny.
Oh, brilliant!
Yeah, so he should represent like the corporate side, and then we got the person trying to buy the service, and I reminded him about, like, spoiler alert for the exercise that your teacher set up, but he's so focused on winning. Like, don't forget that the ultimate winning is you agreeing a deal in the end. Like, it doesn't matter how much you twist their arm, and you might get great
Yeah.
terms. Like, if you don't come to agreement, you both lose. Did you get that?
Oh, sorry, Frederick. Can you
No,
can you
no.
hear me?
Yeah, I say that one more time. It's probably internet on my side. So again,
Yeah.
ultimately, in any negotiation, like, yeah, both sides want to win, but if there is no deal, both sides lose. Can you just elaborate on that? I know you've been working many hundreds of deals over the years.
Yeah, exactly. And look, and the risk of not reaching a deal that you're both happy
Yeah,
is that you might be storing up trouble for a later stage. So if a buyer falls into a position where they've overpaid,
yeah,
you may find post completion that they look for ways to try to chip the price, and that might be by way of coming up with a spurious warranty claim.
yeah.
Or it might be just by saying, just bloody mindedly withholding a deferred payment. And by the same token, if you've got a seller who's pretty disgruntled about um, having sold a business at what they perceive to be an undervalue, if there's deferred consideration
Yeah,
and the buyer needs to renegotiate the term over which that's being paid, for example, there's not going to be much goodwill there. The seller will be saying, well, you've got it cheap anyway, just give me my cash.
yeah,
So there's lots to be said by reaching a deal that both sides can live with and are happy with at the end
yeah,
of that
exactly.
negotiation process.
So what's the difference in terms of price? What's the price they want versus the price they might accept? Why is that so different?
Well, it's that's a good question. Why would there? So very often, I mean, lots of deals that are done through
Yeah,
brokers at the moment.
yeah,
Um, so the brokers would have gone through a valuation process. They obviously get paid a percentage
yeah.
of whatever the business gets sold for. So they have a vested interest in getting, absolute top dollar for the business.
Big.
And they don't really care particularly when they get that because they've got a number of businesses on their books.
Yeah,
Whereas, there are some brokers over here who, have hundreds of businesses that they're selling. All small businesses, but they put a value on them, and they're saying to those sellers, "Don't worry, a buyer will come along
yeah,
at some
exactly.
point, and at that point they get paid their fees." So the difference is very often it's easier doing deals where brokers aren't involved,
I
um,
agree.
and the way those deals are sourced are by
Yeah,
way of direct communication, approaching businesses that you like the look of, or people that you like the look of that you want to buy businesses from.
yeah,
So quite often the difference between what probably is a fair price and the elevated expectations either comes from a seller who has taken no advice at all and
yeah,
has just in their own mind has fixed a price,
yeah.
or it comes from an accountant who they've taken advice from who doesn't specialize in valuing businesses, or it's come from a broker who says, right, we'll get you X for this business.
Yeah. Yeah, I know for a fact many companies I've been speaking to in terms of acquisition that they explicitly does not want to sell to, for example, private equity for different
Yeah,
reasons. Why have many of the listeners to, yeah, sure, we also got PE listeners as well, but the people who are not in
yeah.
private equity who think more on a smaller scale, why can that human connection sometimes be more valuable than ultimately the price?
I think I think the human connections particularly important in SME businesses are
Yeah.
either where people that are working the business are family members,
Yes.
or the people in the business have worked together for years. Private equity has got its place. There's no doubt
Yeah,
about that.
absolutely. 100%.
We see here in the UK, for example, we're seeing private equity go into lots of professional service areas.
Yeah.
So accountancy,
Yeah.
veterinary practices,
Dentist. Yeah.
all these sorts of areas. The one area private equity doesn't really work brilliantly, funny enough, is for lawyers. It,
Okay. Yeah.
there have been very few successful private equity investments
Yeah.
from lawyers, and I think that's almost reflective of the fact that law in particular is quite a personal business. Clients tend to follow individual lawyers rather,
Yes.
unless you're in the big firms. But generally speaking, for smaller firms like mine, people want to deal with individuals,
Yeah.
um, and uh, and the private equity model of which very often results in a depersonalization of the business. Quite rightly so in many instances because you need to make financial savings. The guys are looking for a 3 to 5 year
Yep.
exit usually on these deals. So I get that, but in a people business, private equity can kill the culture. So, for
Yep.
example, there are uh, there's a large private equity owned law firm here in the UK.
Yep.
They acquire lots of smaller firms, um, and they're consolidating them very successfully, very profitable. But
Yes.
what's happening is that on day one when they acquire a firm, they they dismiss all of the support staff because everything's centralized in
Yeah. 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 Yeah.
one big head office. So that first of all causes a morale issue. Secondly, they say, right, clients are not your clients; they belong to the firm.
Yeah. Yeah.
Um, you have centralized billing. You have strict payment terms. All the things that financially make sense,
Yeah.
but in smaller culture firms have been the reason why those firms have thrived. And so suddenly you go from a model where you're saying to your clients, well, look, I should charge you this, but I'll charge you Y instead.
Yeah.
That doesn't happen. It's centralized pricing. You
Yes.
can't give your clients any leeway on payment. Now, many people say, well, why should you give them leeway?
Yeah.
But
Yeah.
it's about building relationships. And so it's that culture clash between the strict, hard private equity model that financially is successful on a big scale,
Yeah.
um, versus the culture model on which lots of smaller businesses, SMEs are built on, and that is, and when I say culture model, I mean that's relationships with your staff,
Yeah.
with your clients, and with your referrers.
Yeah. Let's dig deep into your mind and try to find three really valuable pieces of advice for people acquiring businesses. It can be anything at all that if you have to focus like three really valuable pieces of thinking, what might they be to take away for the audience?
Okay, the first one should be definitely don't become emotionally involved in a deal.
Yeah.
Okay, as a buyer, you always have to be prepared to walk away from a deal if it's not right, either because the price isn't right, or because the risks that are involved in acquiring that business are too high. So don't let deals become personal.
Got it.
Okay, I think that's probably the first important part.
Yep.
Secondly, think about why you are doing deals. So what's your strategy? Are you looking to do a buy and build and an exit strategy within
Yep.
3 to 5 years, or are you looking just to acquire a single business to give you an income for a long-term basis? Because your mindset and your approach to what you acquire
Yeah.
will be very different. And as I said a little bit earlier, um, if like a lot of people, you've been a senior manager or director and employed for a number of years and you're wanting to step away from that, then what you want to be looking for are businesses that have a structure, an infrastructure, and have a staff set up that means that you don't have to work in the business. You don't want to be your own employee,
Yeah. Got it.
really, because what you're doing is you're jumping from having the safety net of an income without the stress and worry of owning a business to
Yeah.
actually having the worst of all worlds.
Yeah.
So that's probably the second point I would make. The third point is really straightforward, and this isn't a sales pitch. Choose a professional team that specialise in this work, because there's not a cat and house chance you would get me dealing with a divorce or dealing with a personal injury claim. I don't have the knowledge. I don't have the experience. I don't know what is a good or a bad settlement in that field.
Yes.
By the same token, a family lawyer or a personal injury lawyer would not know how to negotiate the deals that we do, or know when a point could be considered or conceded in a negotiation and let go, or where you should say to your client, just walk away from it.
Yeah.
The days of the old school family lawyer that did a bit of everything really have long gone, in my view.
Agreed. Yeah. Yeah. So where is the best place for people to follow your work, or maybe to even reach out to yourself? What's the best place?
Okay, so probably I'm on LinkedIn. So if you just search for John Andrews, Ronald Fletcher Baker,
We'll link it.
or Yep, on my mobile is always the most direct and quickest way to contact me. And that is 07768 266 036.
Perfect. And this is an old school trick for people out there to actually disclose a way how people can reach out to you. It's called sales. And advice leads into sales. So thank you very much for sharing the best ways to contact you. The podcast name is Invest in You. What does invest in yourself mean for you? Let's see here. I think I lost you for a second. Can you still hear me?
I can hear you, Frederick. Yeah.
Okay, I'll say the question one more time. So, invest in yourself. What does that mean to you?
Right. So to me, invest in yourself, that's a really good question. For me, I think it's look at what you want to achieve, where you want to end up in life. Do you want to have um, some people very happy to go through life safely, um, but if you're going to go into this kind of area and you're going to take the plunge, um, do it with both feet,
Yeah,
properly advised, and have a bit of excitement.
yeah,
Do it yourself.
love it, love it. Perfect. Good one. I mean, I won't drag out. I would love to carry on for 5 more hours easily. You've shared a lot of value. I will follow up with my personal thoughts and questions later. But you've been a
Yep.
fantastic guest, John. So thank you so much for sharing ideas, how your specialist lawyer can actually help you to get that deal done safer, better,
Yeah.
faster, without question. And again, I would highly regard John. I've been following his work for many years. He's sharing a lot of valuable insights online that you can also find. Good one. Any last few words?
Great. Thank. That's Frederick. Just really enjoyed chatting with you today. Really
Yes,
nice to meet you. Hopefully, we can do something again soon.
indeed. Thank you so much, everyone. All the best.